UK or a US or a Japanese parent company, and you're advising in that country, one of the things that you will spend an awful lot of time doing is getting to grips with the controlled foreign company rules of that country. Very techy, very detailed legal analysis in order to determine what is caught and what isn't caught. And then when it is caught, and the rules do apply, trying to work out how you calculate the profits that arise and are taxable at the level of the parent. So this is very, very noddy example of controlled foreign company rules, just to give you the concept. One of the things we say in this course is the parent company shouldn't be taxed on the profits of the subsidiary until they're paid by dividend back to the parent. This is the big but. So except where a controlled foreign company rule applies, in which case there is the right to tax. It's a worrying right to tax very often because this is something that is just not covered by treaties at all. There are some wording in the commentary. It's not clear from the provisions of the treaty itself that there are wordings in the commentary that says that there's no treaty override. So you would think in some cases that two countries would be friendly countries, they'd negotiate a double tax treaty and they provide in it that controlled foreign company rules don't apply between the two of them, but they don't do that. And in many countries there is domestic case law that says this is an okay rule to have. Okay, so this is a really major area, but there's just not time to cover it in this class. So just be aware there's a concept called controlled foreign companies. Also be slightly aware, some of you are doing US tax. When we say, when you say to a US person what's a controlled foreign company, they'll give you the answer that it's a company that is controlled by the other. So there's a majority vote value ownership. And in US terms, the equivalent of controlled foreign company rules is subpart F. So if you come across subpart F, that's the equivalent. And whilst most countries, when they're applying a controlled foreign company rule, look at the subsidiary that's profitable in a low tax jurisdiction, the US does something slightly different. The US often does something slightly different. The US focuses on the income stream and not on the profits. So it's much more, is there passive income and can I tax it, rather than is there a low tax subsidiary that I can tax. So their starting point is somewhat different, but the rules are there to do the same thing. It's to prevent passive income streams being routed to tax haven and funny structures in order to reduce tax burdens generally. Okay, so that's quite a big thing. In BEPS, there was Action 3, and basically as one of the things that BEPS did was just to try and make the politicians happy, I think, by having lots of actions and undertaking lots of actions. One of the things they did in this area is simply to say, well, lots of countries do have controlled foreign company rules, but we'd recommend that more countries have them. So it's nothing new, it's just endorsing something old. But what they did do is to produce the final report, and in the final report they've tried to help countries who are thinking of introducing controlled foreign company rules on how to go about putting in place legislation. So it's really guidance on what legislation could look like for countries that don't have these rules. So it's a recommendation, it's not a minimum standard, but actually if anybody wants to know a little bit more about controlled foreign company rules, if this is hitting any of your essays or dissertations or anything like that, this is the best place to read it, because this does go through the policy rationale for having it, and does give you some good idea about the sort of provisions that are necessary in domestic law if you're going to introduce a rule of this type. So it's not recommended reading for this course, but it just might be if that's an area that you're wanting to study. Okay, so that's one topic. That's a big topic done very, very, very quickly. Now, next big topic is treaty abuse. Because treaties are there to try and give us double taxation relief. And if they're used in a way that tax authorities think are against what they're meant to be there for, then query, does the treaty apply? And the biggest area where it would impact taxpayers if it didn't apply is the reduction in withholding tax from a domestic rate to a treaty rate. So think about it in that terminology. Prior to BEPS, there were quite a lot of provisions that could be in treaties to try and prevent abuse. Anti-conduit rules to try and prevent you from inserting a company in the middle where dividends are paid up and then up, withholding taxes are. Beneficial ownership rules, saying you can only get the reduced withholding tax in circumstances where the beneficial owner is the recipient of the income stream. Some anti-treaty shopping rules. There were rules in relation to the improper use of the Model Tax Convention and conduits generally. A lot of these provisions were talked about in the 2014 commentary and didn't actually find their way into double taxation treaties. Beneficial ownership did. That came about, I think, in 2010 on the update to the model, and it's something we have talked about. But some of the other provisions aren't there in treaties. They're there in the commentary and not the treaty itself. Some countries felt there needed to be a broader anti-avoidance rule, and there were two of them out there. Countries, again, liking different rules. The UK and a lot of common law countries liked what they called the principal purposes test. So that was saying that provided there's a good commercial reason for doing a transaction and trying to get the benefit of a particular treaty, it's fine. But if the principal purpose is to avoid tax, then it's not fine. There's also a question of how many principal purposes can you have. So there's a question if it's a large amount of tax, then you might have a principal purpose anyway. But it was a subjective test based on what was the rationale for structuring it in that way. The US had a different rule. It had a rule called the limitation on benefits rule. And this rule basically says if you look at the taxpayer, you look at a number of different attributes of the taxpayer, and if they pass those bright line tests, it's an objective test, then the treaty will apply. And if it doesn't pass those bright line tests, the treaty doesn't apply. Okay, so you've got these two tests out there. You'll find them in most of the treaties that have been negotiated. You'll find the limitation of benefits clauses on most US treaties, and you'll find principal purposes tests on most other treaties. You'll find some treaties without any of that, but that's generally the way it goes. And I'm going to skip over this because I want to get to this. This is more important. BEPS Action 6 looked at this whole area and said, well, look, we've got to do more than has happened by chance between different countries. We ought to change